Something broke down in the silver market this week, and it did not go the way it was planned. Tuesday, silver printed at $71.90. By Thursday, the price had ground down further to $71.51. And then, in just 2 trading sessions, it reversed course and closed Friday at $76.71. That is a 520 structural recovery in 48 hours. And the institutions that engineered the downward pressure heading into that low are not in a comfortable position right now. This is OG Peter, and this is SilverDispatch. If you are watching this on Sunday evening before the futures market opens, you are exactly where you need to be. Because tonight's video is not a recap. It is a forward-looking structural breakdown of exactly why that bounce happened, what it signals mechanically, and the 3 specific data points that will tell you whether Monday morning confirms it or tests it again. Drop your location in the comments right now and tell me, did you hold through the 71.51 low? I want to hear from every SilverDispatch viewer who stayed in their position while the screens went red. Let us get a roll call going. But first, let me give you the framework that explains everything you just watched. Because the phrase short squeeze gets used loosely, and I want you to understand the actual engineering behind this week's price action so that the next time a move like this develops, you can read it in real time without needing anyone to hand you the interpretation. Here's the core dynamic. When large institutional traders build significant short positions in futures markets, they eventually need to close those positions by buying back the contracts they originally sold. The problem is that buying into a rising market pushes prices against them and increases their exit costs. So the strategic move is to generate downward price pressure first, creating the conditions that allow them to cover at a lower price than they entered at. The mechanism for generating that pressure involves coordinated selling during low liquidity windows, often timed to overnight sessions or periods adjacent to major data releases or geopolitical headlines. As the price drops, automated stop-loss orders held by retail participants begin triggering. Those stops generate real selling volume, which amplifies the move further. The institution then steps in and covers into that selling flow, exiting its short position at a discount. That is the playbook. And this week, it was executed with technical precision down to the 71.51 intraday low. However, and this is where the week gets structurally interesting, the recovery that followed was not a relief bounce. It was a mechanical failure. 3 specific factors prevented the covering from completing as designed, and each one matters for what comes next. Let me take them apart one by one. The first structural reason the recovery held is delivery volume. COMEX May delivery data shows that 4,648 contracts, representing 23.7 million ounces of physical silver, were stood for delivery in just the first 3 trading days of the May window. To put that in context, the entire month of April 2026 delivered 3,313 contracts, representing 16.6 million ounces across all 30 days. May surpass that total before the first week was finished. Here is why that is significant for the price action you just watched. Every one of those delivery notices was filed before Tuesday's downward move began. The buyers standing for delivery committed to taking physical silver at the pre-smash settlement price, regardless of what the futures screen showed at $71. They are operating under contractual obligation, not psychological pricing. They cannot be shaken out of their positions by multi-session paper pressure. They are going to accept delivery of those 23.7 million ounces, whether silver trades at $71 or 77 cents. That physical demand anchor is the first structural wall the short position ran into. You cannot push a paper price sustainably below the cost of physical delivery when nearly 24 million ounces of real buyers are actively pulling metal out of registered COMEX vaults. The registered vault sits at approximately 80.8 million ounces, with 6.8 million ounces in additional May open interest still to resolve. The math matters. The physical floor held the paper price accountable, and the recovery to 76.71 is that accountability in action. The second reason is the supply deficit. The World Silver Survey 2026, published April 15th, projects a 6th consecutive annual market shortfall of 46.3 million ounces, a 15% widening from the 40.3 million ounce deficit recorded in 2025. Cumulative above-ground stock drawdown since 2021 now stands at 762 million ounces. That is nearly 1 full year of global mine production that has been permanently consumed across 5 years of structural demand exceeding supply. Any short-side strategy that relies on manufactured price declines to generate panic selling assumes a supply-demand neutral environment. This market is anything but neutral. When silver touched $71, industrial procurement teams, solar manufacturers, EV supply chains, defense electronics contractors did not reduce purchasing. They accelerated it because $71 represented a meaningful discount to their internal pricing models. The deficit created more buying pressure at lower prices, not less. That is the opposite of the condition needed for the short strategy to close cleanly. The third reason is the geopolitical anchor. The Strait of Hormuz situation remains an active operational reality. Brent crude held above 105 for the full week and closed May 1st at $108.83. At that oil price level, inflation expectations remain elevated, Federal Reserve rate cut probability diminishes, and the macro environment that supports institutional allocation toward precious metals remains intact. The peace risk-off narrative that coincided with Tuesday's move was contradicted by confirmed operational activity in the Strait on the same day silver recovered. The market priced the confirmed operational reality. That is why 76.71 held into Friday close. Now let me give you the specific Monday morning framework across the three silver vehicles you are most likely holding. Because each one has a different recovery mechanism, and understanding what you are watching at the open matters for how you read the first hour of trading. If you hold PSLV, the critical number at the open is the discount to net asset value. As of Friday's close, PSLV was trading at a 5.17% discount to its NAV of 25.76. That discount widened during the Tuesday through Thursday pressure because retail participants were selling PSLV shares faster than the underlying physical silver price was falling. The NAV held up better than the share price, which means those sellers were exiting at a price below the actual value of the physical metal backing their shares. This is where it gets interesting. PSLV's 12-month average discount to NAV sits at approximately 3.47%. The current 5.17% discount represents a gap that closes through a specific mechanism. As silver consolidates at 76.71 and retail sentiment reverses out of the panic position, share buying pressure compresses the discount back toward that historical average. Every point of compression from 5.17% toward 3.47% is a return that exists inside PSLV and nowhere else. It does not exist in SLV. It does not exist in a mining stock, and it does not exist in futures. Watch that discount at the open. If it begins narrowing during the first 60 minutes of Monday's session, that is your confirmation signal that sentiment is shifting. If you hold SLV, the Monday setup is more direct but carries different risk. SLV tracks spot silver price without the discount compression mechanism. Your entire return thesis rests on whether 76.71 holds as a structural support level. The most important data to monitor is Sunday night and Monday pre-market electronic futures activity. If silver holds above 76.71 SAWs through the overnight session, it tells you Friday's close was not a counter-trend relief move, but a genuine re-establishment of the structural floor. A flush below $76 on low Sunday night liquidity without a fundamental catalyst would warrant reassessment. If you hold physical silver, Monday's price action is frankly the least relevant data point for your position. The physical premium that major U.S. dealers were quoting through Tuesday and Thursday confirmed that the real-world market never validated the 71.51 paper print as a fair value. Physical buyers and sellers during that window were transacting at levels that reflected the structural supply-demand reality, not the futures screen. If you held through that low and you are watching SilverDispatch right now, you navigated that entire sequence correctly. Your bars did not change their fundamental value at $71. They did not change it at 76. The screen changed. The metal did not. However, there is a catch on all three vehicles. The short position that manufactured this week's move did not close where it needed to. That changes the Monday setup for everyone. Here are the three specific numbers I am tracking Monday morning, and exactly why each one matters. First, the COMEX eligible vault reading. Eligible silver, the private buffer inventory that can be converted into registered metal to meet active delivery demand, currently sits at 233.7 million ounces. Total COMEX vault inventory shed a net 13.3 million ounces over the past 30 days, with eligible alone declining 17.5 million ounces as private holders converted buffer stock into registered metal to service delivery requirements. If Monday's report shows continued eligible drain, it confirms that the 23.7 million ounce May delivery pace is real, sustained, and still in progress. That is the most direct, unambiguous confirmation available in this market. Second, July open interest. July contracts are already sitting at 74,536 contracts, representing 372.7 million ounces of forward paper demand. If July OI continues building above 75,000 contracts during Monday's session, it signals that the structural delivery pressure is not isolated to May. It is migrating forward into the next delivery cycle. That would confirm that the 520 recovery from 71.51 to 76.71 represents the beginning of a continuation move, not a counter-trend bounce inside a larger breakdown. Third, Brent crude at the New York Open. If oil holds above $100 when New York equity markets open Monday, the macro framework that produced Friday's close remains fully intact. If Brent drops below $103, it means an energy market peace narrative is gaining traction that has not yet been reflected in silver pricing. Check oil before you make any read on silver Monday morning. Energy is the leading indicator for the macro environment that underpins this entire move. Now let me give you the structural conclusion. Not as prediction, but as arithmetic. The short position that drove silver to 71.51 had one objective: push the price below the level where enough holders would exit to allow short side covering at a profit. That covering did not complete. The 76.71 close is the evidence, which means Monday is not a clean slate. It is a continuation of an unresolved position operating against a 46.3 million ounce annual structural deficit, 23.7 million ounces of active physical delivery demand, Brent crude above $105, and confirmed ongoing Hormuz operational activity. That combination does not make an open short position easier to close as the session develops. It makes it harder. All sources for this analysis are in the description. COMEX warehouse data, silver closing prices, crude oil levels, the World Silver Survey 2026 deficit projection. Pull every number. Verify everything independently before making any decision with your capital. I am OG Peter. This is SilverDispatch. The position that could not close at $71 faces Monday with 76 as the new floor. Leave me a comment, PSLV, SLV, or physical, and how long you held through that low. The vault update drops the moment Monday's COMEX number publishes. This is not financial advice. Everything here is educational analysis based on publicly available market data as of May 3rd, 2026. See you Monday.